What do you do when the money dries up? Rising interest rates have changed the game. After a nearly 20-year run, VC funds and angel investors have left the market. However, there are still opportunities for investing in startups. It's just that now they are a bit different. I'm Jane Singer, and welcome back to A Seat at the Table. Each week, we sit down with industry leaders and innovators who share their business expertise and insights. Today, we're joined by Charles Sidman, founder and managing partner of ECS Capital Partners, a firm specializing in early-stage investment. Charles' achievements include investing in over 50 startup or growth companies, chairing multiple ventures, and serving on prestigious boards and associations globally. In this episode of A Seat at the Table, Charles will be giving us insights into the unique early-stage entrepreneurial asset class. He'll be sharing the risks associated with this asset class and how investors can protect themselves, how investors can unlock the potential of early-stage companies for maximum financial returns, and why he favors deep tech enterprises over other enterprises, and how he evaluates their potential to scale and determines their true competitive advantage. Whether you are an early-stage company or an established enterprise, success today often comes down to having the right people on your team. However, finding those people, especially those with more specialized skill sets, is not always easy. That's why many leading companies turn to AsiaNet consultants. AsiaNet has a legacy of being able to fill even those difficult-to-fill roles. Their global network, built over 3 decades, gives them a key advantage in finding the right people for the right positions. You can learn more about them at asianetconsultants.com. I'll also leave a link in the show notes over on our website at seat.fm. Meanwhile, let's find out how we can profit from investing in early-stage ventures. Charles, thank you so much for joining us here on A Seat at the Table. I am really excited to have you on the show. I think what you're talking about is particularly interesting right now because the market has changed a lot in the past. I don't know if it's been a year yet, but certainly since interest rates have started going up, and it certainly had a big impact on a lot of financial decisions and investment decisions in particular that people are making. So this is really a good time to have you on the show.
All right. Well, I'm happy to be here. So thank you very much.
So talking about interest rates, I mean, that has certainly had an impact on financial or really on investment decisions. Certainly prior to that, for maybe, I don't know if it would be 20 years or roughly that, VC funding was fairly easy to come by, angel investment and things like that. And now suddenly that seems to have dried up. There's a lot more pressure on companies, startups, to be able to show profits. I think it'd be interesting to hear your take on where you might see opportunities for people who are looking to invest in some of these, what you might call higher return asset classes.
Well, do you want to look at opportunities from the investor point of view or from the entrepreneur point of view?
I think that both are interesting. And I think that if we talk about from an investor point of view, and then we can circle back and say, what do people who are starting something need to think about differently? Because obviously the scenarios change, so they probably need to reposition what they're doing as well.
Okay, well, I think the first thing is we should recognize that investment and early stage investment are two different things. So, what I do, venture and startups and stuff, is early stage, and it's a sector of overall investment, but it's not the same thing. And the macro trends apply to all economic activity, but look, people are always starting enterprises, having ideas and starting enterprises in the worst of times and in the best of times. And actually in the worst of times, when the needs are most acute and the stresses are most, wearing, that's a great time to be starting businesses because the needs are clearer and maybe the solutions are clearer too. So even when the big, investors in the big financial world is having a lot of angst about interest rates and, that sort of thing, are starting up all the time. And it may be never a better time than the present for the entrepreneur. For the investor, we're going to talk a lot about diversification, and the startup world is a sector of the overall investment world, which operates, in a different way. It marches to a different drum. It's not heavily interest dependent because no banks are going to lend to a startup which has pre-revenue. So that's a question of individuals who can see the potential and the belief. It's a high return activity.
Mm.
but it has different, parameters in terms of risk and timing and that sort of thing. So it should be part of everyone's investment portfolio and overall approach, but it's not synonymous. And I think everybody should have some eggs in this basket at any time, at all times.
Right. I think that's an interesting point of view because, as you point out, it is high risk. And for a certain sector of the investment community, it becomes less attractive when lower risk opportunities have potentially higher returns when interest rates are better. So what are you seeing around that? I mean, how would you narrow the focus on that if you were talking to a client?
Well, when we talk about risk, there's two kinds of risk. There's the risk of every single check an investor writes, and then there's the risk of participating in the asset class.
Right.
And so in the early stage asset class, I do think every check is somewhat riskier than sending a check to a bank or buying a piece of real estate, which has, rents and income flowing. Overall, the activity is investing in the early stage asset class is not more risky if you do it well and professionally and in a disciplined way. The year over year, decades long, forever rates of return compare and exceed the safer investments. And that's because of diversification. One 10x return makes up for 9 complete flops to zero. Now, those complete flops to zero are, very painful, but the 1 to 10x return has made up for them. And if you get a, 30 or 100 or a 500x return, you're way ahead. So you're really, getting most of your return from a relatively small proportion of your investment bets. That's the way it is. The participation in the asset class is way more lucrative and, in a sense, less risky than the traditional safe investments as a class.
Right. I think that, when you're looking at it, certainly that makes a lot of sense, but that tends to skew, and maybe that is who you're addressing, towards people who do have a tremendous amount of money to invest and can potentially lose it, right? So that you can invest in, I suppose, the classic way, which is investing in a tremendous number of startups, figuring, as you said, that many of them will fail, but you'll get those 1 or 2 big ones that give you massive returns. How might someone approach this who might be a smaller investor or wanting to in some way have a buffer against that downside risk, even if it means a little bit less on the upside?
Well, I would say let's not think about buffers. The big board stocks, stocks return 5 or 10% per year over, the last century. Traditional venture capital is 15 to 20. Early stage venture capital, which is what we're talking about mostly here, is 25 to 30. So the aggregated overall return from the asset class is very attractive. And yes, there's some emotional angst about the riskiness of each potential check. But if you do it well, everybody should have some eggs in that basket. And, in the bad times when the big board is going down, the entrepreneurs are still building value and seeing opportunities. So how does a little guy or girl participate in it? That's what you asked. And that's really the genesis for the fund, which I have formed and operate. It's to allow everybody. Now, they do have to be accredited investors by the SEC definition. So they're not, everybody who graduates from college, but, we have millions and millions of successful professionals in our country, millions of them. And most of them are very busy doing other things. And they don't want to initially allocate substantial amounts of money. So we allow people to get involved in the game with, multiples or minimums of 25,000. Yeah, sure. We're happy to take 2 million or 10 million, but we'll allow smaller investors to invest as little as 25,000 and put that money into a very diversified portfolio that's professionally managed. So everybody can get the benefit of this asset class without having to be a full-time, professional in this field.
Yeah, I think that's an interesting opportunity for people because, as you say, if you don't have the time to sit there and really do your own analysis for each of these companies and vet them in the way, right, that a company that does VC funding for a living does, it can be very, very difficult. You're more or less gambling rather than making any kind of an investment. So it's interesting that you've been able to put together a fund where you're sort of doing the work like that, if I'm understanding you correctly, on behalf of investors.
Well, that's true. And really what's hard for the average potential investor or angel, they're called, to do, there's three main challenges that a professional organization can deal with. One is deal sourcing. And a big VC firm in Boston or San Francisco has applications that they can't even deal with, a huge flow of applications. So they don't have any deal sourcing problem. They don't tend to reach the good opportunities that are in, Chicago or Des Moines but that's one of the things I do. I have a tremendously diversified reach geographically. The second thing that a professional does is has the discipline and the analysis that you spoke of. There's a science to it, yes, and it takes many years to learn that science, but anybody can learn it, just like they can learn to ballroom dance or drive a car or an airplane. And then thirdly, it's not just writing the check. It's actually the follow-up, because these investments take an average of 7 or 8 years to mature. That's an average. And, some are much quicker, some are much slower. And that means you have to be involved and on your toes for a lengthy period of time, because events come up and decisions need to be made, and you have to be plugged in, ready to, decide, have the resources to participate if you want to. And most people, if they're running, a dentist office or a business or whatever, don't have the ongoing flexibility and time to devote to always being ready and always having the resources.
Yeah, absolutely. Now, it's interesting because you talk about that you say that you favor deep technology enterprises. What specifically do you like about them?
Okay. Well, there's several answers to that. First of all, my background before I turned into an investor primarily was in technology. I started my life as a computer entrepreneur, still in my teens and 20s. And then I went into biomedical research. So I was always dealing with science and technology. So I can deal with it. I can understand it and make decisions on it probably better than most people who don't have that background. And in that sense, every professional venture organization will hire experts. In my case, my money is where my mouth is, that my money's going in alongside of I'm the expert and the investor at the same time. So I'm not just rendering an opinion. I'll feel the gain or the pain along with everybody else. The second thing is that technology allows scaling and these outside returns. Now I'm sitting in an entrepreneurial venture, my wife's entrepreneurial venture, which is an art gallery. It's based on aesthetics and not technology. So she's had a wonderful, run of 30 years in this business, but it's not scalable. She's the secret sauce. Right. I can't make 2 or 10 of her, or find double or 10 times the number of artists. That's a different kind of business. It's not going to scale and grow. We know this, but in terms of diversification, in terms of our family and our life, we've diversified. Here's an entrepreneurial business which is not scalable, but it's steady and reliable. And the things that I do are potentially scalable, a different kind of return. So they're just different businesses. So that's why in what I do in the early stage investing, I tend to favor technologies over, let's say, business models or fashion or things like that. It's a matter of preference, what I'm enabled through experience to deal with and really add value to. And then the other thing that I will have to throw in is that my investing is done through a lens of impact, positive impact. Yes, I'm first and foremost an investor looking for financial returns, but I want to do that through enterprises that make the world a better place in a positive way. And that's obviously an individual decision and set of values, but things in health or things in sustainability and renewable energy, that sort of thing, very much motivate me. Drilling and pulling more oil out of the ground, or making synthetic narcotics, or there's all sorts of things that make a lot of money, but don't interest me to participate in.
Yeah, I hear you on that. Now, when you're looking at these companies, and I know there's a lot to unpack around this, but if you could just at least give us a short view, What do you look for when you're looking at a company to determine whether you feel that, they have true competitive advantage, whether you feel that they have a real potential to scale? Are there certain key signals that you look for when you're vetting companies?
Right. Well, it's going to all boil down to, I want to see the prospect of a 10x return for me in 5 years. That's the financial goal that we have. That amounts to a 60+% growth rate per year. That's very aggressive. And I want to see at least a feasible path to that kind of outcome. I know it's not going to happen in most cases, but that's kind of a bottom line that has to be reasonable to me. So I go through 4 steps in trying to, see if this is reasonable. So first I look at the problem or opportunity that they're addressing. And this is where my moral or ethical sense comes in. If it's growing a better tobacco, I'm not interested in it. But if it's growing a medicinal plant, I might be interested in it. So the second thing is, are they going to really move the needle? And this is where my technical understanding and experience comes in. Someone says they want to address a major medical issue. Well, I'm a former medical professional and I can understand it, and we can talk about the science and technology. And I was just on a call yesterday where I thought they were making all sorts of claims that weren't justified scientifically. So I'm not motivated to participate in that. Thirdly, you've got to look at the people who are doing it, because they're the stewards of the enterprise and you have to believe in them. You're going to be working with them. And it's not just the documents they write, the patents that they've written, the business plans they've written, it's them as people. So I very strongly believe you have to interact with the entrepreneurs and get to know them and, pose tough questions and see if their eyes shift and they don't answer the question, or if they, BS you with a phony made up answer, or if they're honest enough to say, well, that's a really challenging issue. Let me think about it and get back to you. The latter kind of entrepreneur is someone I think I can deal with. And then fourthly, it's the deal itself. So with 25 years of experience, I have seen a lot of deals. I've participated in a lot, and some are organized such that, maybe the entrepreneur can sell some people on this proposition. I have enough experience to know that, well, that's really not a good situation for me to get into. Good luck for everybody else, but I'm not going to do it. So some familiarity and experience with the actual legalities and, ways that the contracts are built is important.
Yeah, absolutely. And I think it's important what you brought up about your deep knowledge, having hands-on worked in biomedical and biotech, where you have that insider's view of the industry, not just a knowledge of the financial side of the business. And I think that's sometimes very hard to replace when you have people who understand finance very, very well, but don't understand the nuances of a particular sector.
Well, that's one issue. Second issue is the technology, because every technology, proposal or startup has respected authorities vouching for it. And, you can't believe everything you hear. So you have to make your own decision. And then thirdly, you've got the technical people on one side and you've got the business or finance people on the other side. They have to talk to each other, and very often they don't. So each one makes its claims independently, and it's really the whole package that you have to accept and buy into.
Yes, absolutely. I think that, we've seen a lot of cases, right? I guess Theranos comes to mind, where the train sort of jumped the tracks. And I'm sure there have been others that you would be aware of and that I certainly, wouldn't have on the radar. So the points that you're making around this are really valid. Now, when we look at this from the other side of the table, so to speak, from the person who's looking to get funding, right? From somebody who's looking to get that early stage investment funding, what do they need to know nowadays? I mean, in the old days, it seemed like there was an awful lot of money that was easy to come by. I'm sure if you were looking for that funding, it wasn't quite as easy as it seemed to the rest of us. But I suppose that, relatively speaking, it may be a bit tougher nowadays. What do people need to know?
The message I give most often to aspiring entrepreneurs, you obviously need to know your stuff, your market, the product or service you're trying to produce, the technology, all the business preparation and stuff. You have to know all that. But when you go into meetings with potential investors, remember, they're not necessarily going to chase you. And these days, that's going to happen even less. You have to chase them. It's a marketing, it's a sales proposition. And so you have to find out what your potential investors are interested in and to see if you can satisfy those interests and needs. Some investors will still invest in just an idea, a vision. Others want to see demonstrated, revenues and, growth, hard numbers. Others want to have, ethical or impact lenses. So they'll invest in things that are, sustainable and renewable energy. You have to know your audience. And so really approach investment raising, fundraising as a sales and marketing activity. You're not just putting yourself on display. You're trying to get to know your audience and figure out what each individual or each group is looking for, and then see if you can address it.
Yeah, I think that's an interesting way to look at it, and probably a bit more challenging when you're trying to pitch this to multiple different potential stakeholders. We're going to take a quick break now, and then we'll be right back.
We were hiring when we were making 50 to 100K monthly losses.
And why? Welcome to episode 1.
I can't think of a single founder who's been around for a decent amount of time in business who hasn't had their tunnel of year. This was that year. We're going to be okay, yeah, Sheree. Some are going to hear this and think, you TDP. But hear me out. You only have to do the math to understand that very soon we were $500,000 down.
It is challenging indeed. And so what I've just said is it's why some people want to live in a bubble and just sort of put themselves out there, build it, and they will come. Well, right. I don't believe that's feasible anymore.
Yeah, absolutely. I mean, it does appear, and I'm not in the industry myself, obviously, but it does appear that right now there's a lot more founders and early stage companies that are looking for money than there is money looking to invest. I don't know if you're seeing it from that point of view. I mean, if it looks that way to you as well.
Well, it is certainly a somewhat, stressful time for the early stage, entrepreneurial fundraising. Part of one piece of that is that, I have lots of investments that are cooking now, and it's always a balance. Do I write my next check as a first check to a new enterprise, or do I write my next check to support a company that I already know and believe in and have had a lot of positive, experience with, and they need a little more to survive or to prosper, take the next step. So that's one issue, which is always on the table. Another thing I would say is we're talking here about raising money. When an entrepreneur goes out to fundraise, they should actually be thinking that they're looking for more than dollars. They should be looking for team members, because every investor who has the ability and possibility of writing them a check also has huge experience. Most entrepreneurs, it's their first or second or third venture. You can write it on count them on a hand. Someone like myself, I see 1,000 or more a year.
Wow.
And I've invested, I've participated in many, over 100 enterprises. So, that kind of experience and connections and, observations, if somebody can get a check out of me, that's great. But if somebody can make use of and involve my experience on their team, it's really a long-term relationship or a marriage, because we're going to be working together for, 5 or 10 years. And if my experience can be put to use on the team, it's far better than just me writing a check and hoping for a big one in 5 or 10 years.
So then, if I'm understanding you correctly, are you suggesting that the investor would be investing money and also providing some kind of guidance or contribution that's non-monetary? Or are you saying that the investor might be investing sort of sweat equity as opposed to capital?
Well, if the investor invests sweat equity instead of capital, then they're joining the team as one of the founders, and that's certainly possible. I've seen it happen. But in the angel world, it's often been recognized that you're after my money, but if you're after my knowledge and experience, you're much smarter. And so, a company's cap table, it might have 20 or it might have 120 lines on it. They can't have 120 or 120 board members and counselors. That's not practical, but among those 20 or 120 will be some people who really have a lot to offer. And when they're interacting with them and trying to get that number of checks, they should also be thinking of recruiting people with skills and experience different from theirs that are complementary, because there should be one or two investors on the board. There should be some investors who have, domain experience on an advisory board. And so the entrepreneur who doesn't have this in mind, isn't aware of it, and looking for that complement to their existing team is really, shooting themselves in the foot. And if they get funding from an investment group, whether it's a firm or an angel group, obviously every beneficial owner or contributor is not going to have this ability and have that relationship. But, somebody from the VC firm or the angel group will very likely be a contact between the company and all of the other investors, can help with further fundraising, can help with connections, experience, et cetera. So really, an entrepreneur who's just thinking about money is not really realizing the bigger picture.
Now, just one other question, and that is that, we're talking about how things might need to change from the point of view of the company that's seeking that funding. I know previously most of the focus was really on top line growth, was how fast you can scale the top line. And it was sort of like grow the top line and the bottom line eventually will take care of itself. It seems that now there's a lot more pressure, or at least a lot more attention on how we're doing with the bottom line. So from the point of view of somebody, who is trying to now be able to get funding, do they need to sort of reconfigure their plan that says we're going to grow, but it may be a bit slower, but we need to be able to support that bottom line?
Yeah, I understand what you're saying, but I would suggest we not generalize.
Okay.
There are some investors who want to see the bottom line. There are some that really just want to see the upward trend in the top line because they know that that's going to be a sellable, exitable investment opportunity. And honestly, that kind of person doesn't care if there's ever a bottom line,
right?
A positive bottom line. Most of the enterprises at the stage that I invest, they don't have any top line. They're pre-revenue. Right. So I can't look, or I'm not looking for a steady growth in that top line or the bottom line, but I want to see a prospect of it, that I can believe in it, that there's a plan to get there, and there's the flexibility to change along the way. If an entrepreneur is not thinking about these things and working towards them and aligned interests, if they just want to have a steady job or a desk, then they're what's called a lifestyle entrepreneur, and that's a fatal label to get stuck with.
Yeah.
Ideally, the interests of the investor and the entrepreneur are aligned so that they both make a lot of money in the foreseeable future together.
Yeah, that makes a lot of sense. Absolutely. Well, Charles, thank you so much for joining us here on A Seat at the Table. You've shared a lot of really interesting information, very timely. I think that people who are listening to this podcast would love to be able to connect with you and perhaps take the conversation further and go a little more in depth about their specific situation or interests. How can people connect with you? Where can they find you?
All right. Well, they can find me on LinkedIn.
Okay.
And that has website and phone number. They're free I would prefer either a phone call or an email is best, because I don't live on LinkedIn. And, if they want to talk about, I can give them some advice. I'm not likely to invest in any particular, person who calls me, but I can certainly give them some advice, because what goes around comes around, and people have helped me out, and I want to return the favor. But some of these conversations will end up as either explorations of investment. Either way, maybe I'll invest in them, or maybe they want to have some of their assets invested in this asset class. And honestly, I think I'm a great way for them to do it without turning their whole lives upside down, to do it themselves.
Yeah, absolutely. Well, I'll definitely make sure that the links are in the show notes, and you can
Okay.
always find the episode over on our podcast website, seat.fm. I think a lot of people will have the opportunity to hear you, Charles, and to benefit from your wisdom.
All right. Well, we all play our part, and together we can move the world forward. So thank you very much.
Absolutely. And thank you so much for joining us, Charles. Really been a pleasure to have you here.
For me as well. Thank you.